That is here. Akhil, we can go live now.
Or we wait for 2-3 minutes? How many people have joined in?
Let me check. So we have
51 attendees.
52 attendees.
Yeah.
Let's wait for 3 minutes. I think let this go beyond 100 and then we can.
Sure.
Akhil, thank you. Amazing webinar you have planned.
Thanks, sir. Thanks for your kind words and thanks for your time. I know you've been keeping busy, but thanks for taking this time out.
But Nitika and Shrenik, we look forward to hearing your views, as do many of our members.
Sure. Thank you, sir.
Mr. Chandan, I think we should start now.
Fine, I think let's go live. Shall we go live?
We are live.
Yeah. Good afternoon, everyone. Warm welcome to an engaging session on navigating one big, beautiful bill as hosted by the Indian-American Chamber of Commerce. As many of you may have already known, the bill was officially announced and signed into the law by President Trump on 4th of July 2025. This act marks a significant development in U.S. tax policy, bringing forward a broad set of reforms that impact individuals, businesses, and industries at large. From permanent extension of key tax cuts, jobs cuts provision, to new incentives aimed at encouraging investments, innovation, and compliance, the bill is reshaping the way the taxpayers and organizations approach financial planning. In today's webinar, we will explore the key provisions of the Act, its anticipated impact across various sectors, what it means for individuals, businesses, and communities at large. Our esteemed panel of subject matter experts will walk through the key provisions of one big, beautiful bill, offering practical insights to support strategic and well-informed decision making. We are very glad that today we have Dr. Atul Chauhan, who is the Regional President, IACC, and Chancellor, Amity University. I would like to introduce Dr. Atul Chauhan at the Indian-American Chamber of Commerce webinar. He's the Chancellor of Amity University and President of Amity Foundation, which is global education group with 2 lakh plus students studying in campuses across India and 15 countries. Dr. Chauhan is a member of many government and statutory bodies, including being a distinguished fellow of Institute of Directors and a member of the Expert Committee of University Grants Commission, a statutory body of Government of India. Dr. Chauhan sits on many boards, including ASSOCHAM Europe and the Netherlands India Financial Corridor. Dr. Chauhan has received many awards by organizations like Economic Times, CI, and is also the recipient of multiple honorary doctorates by the universities in the UK and US. He has been featured in many of magazines covers like Forbes magazine. Dr. Chauhan, we are very thankful and we request you to share your initial thoughts on the OBBBA and the overall direction the US economy is expecting to take over the next 5 to years because of this introduction of this beautiful bill. Over to you, sir.
Thank you so much, Akhil. First of all, thank you so much for organizing this very relevant webinar online, and congratulations to you for that, especially from the side of the Indo-American Chamber of Commerce, where you are such an important pillar of the organization. I'm very glad to see so many people online who will benefit from this discussion series, and I welcome each one of you. It gives me immense pleasure to welcome you on behalf of the Indo-American Chamber of Commerce at this such a timely and important webinar on navigating one big, beautiful bill, a strategic industry perspective. As we all know, on the US's Independence Day this year, President Donald Trump signed into law this One Big Beautiful Bill Act, which is a landmark legislation and is being described as one of the most significant fiscal reforms in US history. It will bring sweeping changes to the American tax policy, introducing permanent extensions to key provisions of the Tax Cuts and Jobs Act, while also offering fresh incentives for both individuals and businesses. For global businesses, for the US industry, and indeed for all stakeholders connected with the US economy, the bill marks not just a policy change, but a paradigm shift in the fiscal architecture of the United States. For the Indo-American Chamber of Commerce, this discussion is especially relevant. India and the US share one of the most dynamic trade and investment partnerships in the world. Our companies are deeply interconnected, whether through technology, manufacturing, services, or supply chains. Any major reform in the US fiscal and tax landscape inevitably has a ripple effect across industries, geographies, and investment flows. With the new bill, we are likely to see both opportunities and challenges. On one hand, the Act's permanent tax relief provisions and incentives for business investment could unleash new growth, encourage capital formation, and strengthen US competitiveness. On the other hand, industries will need to carefully navigate its implications on compliance, global taxation, cross-border investment, and trade dynamics. I'm sure many of the speakers today will touch upon these areas. As the premier binational chamber promoting India-US economic relations, the Indo-American Chamber of Commerce is committed to being at the forefront of dialogue on such transformational change. Our role is to ensure that businesses on both sides have clarity, foresight, and confidence to navigate such reforms. This webinar is part of that mission. By bringing together leading experts, policymakers, and industry voices, we aim to decode the new bill, examine its implications, and identify strategies that can benefit both Indian and American enterprises. In conclusion, the One Big Beautiful Bill Act is more than just a piece of fiscal legislation. It is a signal of how the US envisions its economic future. For us, it is an opportunity to reflect, adapt, and align our strategies in a way that strengthen the Indo-US partnership. I look forward to a stimulating and insightful discussion today, and thank all the speakers who will be coming. Thank you.
Thanks, Dr. Adu Chauhan, for your kind words and an outlook and the way you look into this bill. You rightly said there are a lot of opportunities and challenges which come hand in hand, and we need to look into that, and through our expert today, we need to navigate what are opportunities for the people and the challenges they have to overcome, and compliances and impacts they need to look into. Thank you. Now moving to our speakers, let me start with an introduction of our first speaker, Nikita Gulati. She's a partner with Grant Thornton Bharat, who comes with an extensive experience of 14 years in U.S. tax consulting and has diverse experience in preparation of U.S. tax returns and in managing U.S. compliance for that matter. She's a CPA, which is a certified public accountant, and specializes in U.S. tax advisory, and is actively engaged in assisting many Indian companies in setting up their business operation in the U.S. and advising them on the tax and compliances uh, in the U.S. as well. She has provided services to various industries like manufacturing, telecommunication, consulting, IT, ITES, etc. Her areas of expertise include U.S. corporate tax compliances, U.S. corporate tax advisory, U.S. transaction advisory, U.S. compliance for venture capital and private equity funds. Nikita, before we go to the next introduction of next speaker, you want to say a few words or say hello to everyone?
Hi, everyone. Thank you, Akhil.
Thank you. So, moving to our next speaker, Shernik Kotak, who's a director with Grant Thornton Bharat, and he's based out of Bangalore. He's an Indian Chartered Accountant, FCA, and a US CPA. I think with overall experience of 13 years, including 10 years in US tax. He has extensive experience in handling corporate tax and partnership tax matters. He has rich experience in dealing with startup ecosystem and helps company to meet their US tax compliances requirements and provide valuable experience in advising them. He also closely works with the US entities of many listed companies in India in their tax advisory, due diligence, and compliances, etc. Shernik, you want to say hello to everyone, please?
Hi, everyone.
Thanks. Now moving to our next speaker, Shashank Chan, who also comes with 12 years of experience, with nine years of extensive experience in U.S. tax compliances, and has been extensively involved in the preparation of U.S. tax returns and in managing U.S. compliances matters for U.S. entities. He is a qualified chartered accountant and specializes in U.S. corporate tax compliances, advisory, compliances for venture capital and private equity funds, and tax planning for HNIs. So he has provided services to various industries, including telecommunication, manufacturing, financial service, IT, ITS. Shashank, you want to say hello before we come to the main presentation?
Thanks, Akhil. Hi.
Hi, Shashank. So we have mix of panel with experience widely in different industry sectors, majorly on the US, and all of them have almost more than 10 years of experience. So let's hear from our such an extreme panel today, and I'm also looking forward to learn a lot of things and making notes while they are taking us through the one big beautiful bill. Thank you. Nikita, over to you.
Thanks, Akhil. Can we have slides, please? Thank you, Akhil, once again, and very good morning, good afternoon, or good evening to our viewers joining from different parts of the world. Welcome to today's session, where we'll unpack the landmark reforms introduced by the One Big Beautiful Bill Act, OBBBA, and explore how they permanently reshape the US tax code. We'll begin by examining the key provisions that have now been locked in for the long term, such as reduced marginal tax rates, expanded standard deductions, and enhanced child and adoption credits for individual taxpayers. During this session, we will shift focus to the corporate front as well, where permanent 100% bonus depreciation, expanded Section 179 expensing, and restored R&D, which is the research and development deductions, are set to drive innovation and investment. Finally, we will dive into the international tax regime overhaul, including refinements to GILTI, Subpart F rules, adjustments to BEAT and FDII, the broader implications for cross-border taxation, including the introduction and withdrawal of Section 899. Together, these changes mark a bold step towards simplification, competitiveness, and strategic growth. This is all will be covered today in our webinar. Next slide, please. Thank you. Now, a bit of a background about this bill. So the Tax Cuts and Jobs Act, the TCJA of 2017, marked a historic shift in US tax policy, lowering corporate and individual tax rates, simplifying certain deductions, and introducing new international tax rules. Most importantly to note, GILTI, FDI, and BEAT. While it aimed to stimulate growth and competitiveness, many of its provisions were temporary and were set to expire by 2025. Enter the One Big Beautiful Bill Act, a sweeping tax and spending reform signed into law on July 4th, 2025, symbolically aligning with Independence Day in the US. This legislation permanently extends key TCJA provisions and introduces new tax relief measures, which primarily include full expensing of certain qualified property, restored R&D deductions, and recalibrating on the international tax rules. The One Big Beautiful Bill Act, signed after a razor-thin margin of 51:50 Senate vote and intense House representations and negotiations, permanently extended and expanded those reforms, ushering in a new fiscal policy of the era. On that note, let's understand the changes brought in by the OBBBA. And on that note, I hand it over to my colleague Shrenik Kotak, who will be covering few changes relevant to individual taxpayers to begin with.
Thanks, Nikita. First of all, thank you, Akhil. Thank you, Atul, sir. Thank you, ICC, for giving us this opportunity and providing this platform. And thank you, everyone, for joining us on this webinar. So from the individual tax perspective, as Nikita rightly mentioned, so when the Tax Cuts and Jobs Act was technically introduced, and it was expected that Mr. Trump will continue for the second term, wherein the first changes which they have brought in the TCJ will kind of give us the benefit down the line. But it kind of hit the COVID. President Trump was not elected, and technically, as a tax preparer, we were very much expecting this bill to come, but we were not expecting it will come this fast, to be honest. So it was, I mean, June month was a more of a marathon for us, and here we are presenting the changes which are there in the OBBBA, extending some of the provisions which were there from the last act and some of the new provisions. One of the key change which was there, just like we have in India for the progressive tax system in the new regime, old regime. So similarly, the US also have a progressive tax system starting from 0% to 10%, which it goes till 39.6% until 2017. So in the Tax Cuts and Jobs Act, this 39.6% was temporarily reduced to 37%. So which means that your highest income, basically the HNIs, ultra HNIs, will be taxed at 37%. This was a temporary provision which was set to expire in 2025. But under the new act, OBBBA, they have made this 37% permanent. So now at least the HNI community will be definitely happy to see this permanent extension. Additionally, just like we do see in India as well, the slab rate kind of changes basis the inflation every year. Similarly, it's there in the US as well. So it's the inflation adjustments which they have kind of kept it. So earlier it was this inflation adjustment was there for all the brackets. So all the income were kind of slightly increasing their brackets, but now this will be restricted till the income which is there up to 22%. So over and above that, the income slabs will not change, and until 22. So the idea is that to give the middle class of the Americans the benefit of the inflation technically adjustments, and HNIs anyway do have a sufficient money to pay the taxes. So that's the kind of the logic which they have applied. But yeah, that's the change from the tax rate perspective. So now 37% is the highest tax rate under the US tax federal law, and it will be taxed at 37% as the maximum rate. The next one is something which is the new, which was there. So this personal exemption was previously there and before TCJA. So in TCJ, this was kind of suspended. Specifically, this was given to the senior citizens, which is 65 years and above. But now that has been kind of reintroduced under OBBBA Act, and it will be allowed as a 6,000 per individual. So this is to the senior citizen who are kind of earning less than $150,000. So it's more of to give the support. It's an indirect support which has been given by the government to those families, and this exemption has been reintroduced for that matter. If your income kind of increases this a slot of $150,000, this will this exemption will start reducing it. In the US, as you know, you can file merit filing jointly. So if there is a husband and a wife, both can claim it as a 6,000 each. So $12,000 is the maximum limit, which can be claimed as an exemption. Having said that, this both the spouses should have the SSN number, which they have to report it on the tax return. So $6,000, whoever wants to claim has to report that. So if it's a single filer, 6,000. If it's a merit filing jointly, then it's a $12,000. If you have a dependent for that, then you can multiply it accordingly for that matter. Next slide, please. Thanks. Yeah, so this is also one of the key change which was brought in under the Tax Cuts and Jobs Act. So earlier, I mean, there was technically no restriction as such for the taxes which you paid at the state level. So as you know, there is a federal income tax, there is the state income tax as well. So that is when I say state income tax, it also expands to the property tax, any other local taxes you might have paid to the states and the cities or the counties, whatever is there, so that you can claim it under the federal. So this was capped at $10,000 per year. So basically, those who are kind of HNIs or have a good amount of, I would say, incomes in the particular state, they were not able to take it. So even if you have paid $50,000 of state taxes, you were still able to take only deduction of $10,000 for merit filing jointly. So it's a $5,000 per individual. So if you are filing merit filing jointly, it's $10,000. So now that capping has been increased to 40,000 for at least next 2 years as a maximum. So 40,000, 40,400 basis the inflation adjustments what they have right now introduced. So 40,000 is something which you will be able to now claim as a reduction. From 2017 to 2029, whatever you claimed last year, of 101% of that you will be able to claim. So if you have claimed less, you will be able to claim less amount for 2027 to 2029. Having said that, you will not be able to cross the limit of what you have already claimed last year. So that's that. However, again, this $10,000 is expected to revert back to $10,000 in 2030, and whatever is there currently in the TCJ, that will be kind of coming back in 2030. Hopefully, we do see extensions post that also, but as of now, that's the law which has been passed. Having said that, this again, the reduction is only till the income level. So if you have a modified adjusted gross income over $5 lakh or $5,05,000, then technically this will start getting reduced. So 30% it will start getting reduced. And having said that, it will still not be below $10,000. So 10,000 you will still get it, but the benefit is only to the income level of less than $5 lakh is what the law has been passed. So
I think I have a question here.
Sure.
If you don't mind, sorry, I'm stopping you in between.
yeah, please.
You talk about the SALT deduction, which is getting phased out under, OBBBA, and this is, I believe, impacting high income taxpayers.
Yes.
Are there any ways to reduce its impact? If you may throw some light on that.
Sure. So the idea, so basically, if you are filing merit filing separately, technically you might be able, you may kind of check that whether merit filing jointly will make sense to you. That can be one of the ways. Alternatively, more from the tax planning perspective, if you are doing certain businesses, you may want to route through the partnership or the corporate kind of a model, and then claim or pay the taxes of the income which you are earning. So HNIs, of course, will have a high level of income. So if they are earning directly in their personal name, this restriction will still apply. But if they are routing through a partnership or to a corporation, this state tax limit deduction technically may not be applicable to the corporates and the partnership, because some states have started allowing the partnerships to claim the state tax deduction without any limits. So directly, there may not be a direct way to increase this limit, I would say, but there can be a potential tax planning or the business planning which can be done for the HNIs, basically, who will have to manage those extra taxes for which they are not getting benefit at the federal level.
Wonderful. And one more thing before you move to the next slide. I think in the last slide, you've spoken about 37% as a top marginal rate, from 2026, which will impact everyone. So how this will impact Indian HNIs or NRIs with high US, income? If you can talk about that as well.
Right. So that's actually going to be very helpful, especially for the NRIs who are kind of based here in India or having the green card or the US citizenship where their global income is taxed. So technically they become a tax resident here in India as well. They become tax resident in the US as well. So whenever they are kind of claiming the foreign tax credit, so there may be a capping on what the amount of taxes, which is the India. Ultimately, India is going to allow how much the tax which they are collecting against what they are paid in the US. So ultimately, if say assuming their effective tax rate in India is coming so 30%, so whatever they have paid in the US was technically their cash outflow over and above which was there. So now that cash outflow has kind of reduced by 2.5% or so for them. And ultimately allowing it to save on those cash outflows, which they'll be paying here in India. So from the foreign tax credit perspective, this will be helpful. Wherever the effective tax rate in India is more or less below 37%, they are good to go, and they will not be paying anything here in India as long as they are able to claim foreign tax credit in India as per the Indian law.
Understood. I think it looks like both the provisions are more or less beneficial.
Yes.
So thanks for inputs. You can proceed with your presentation. Thank you.
Thank you. This taxation of tips, basically there was no deduction. So when we said tips, basically this restaurant industry tip is something very common which we have seen in the restaurant industry. So basically this was earlier this tips were being taxed. It was included in a W-2 and you have to pay the taxes. However, there has been a deduction which has been now allowed under the OBBBA Act, and deduction has also been allowed up to $25,000 for the qualified tips. Having said that, there is of course an income cap that if you are earning more than a certain amount, then this capping will kind of start reducing every $100 for $100 for every $1,000 which you earn. So the capping or the idea is to give the benefit to the low income workers to get the benefit of the tips which they are earning, and that's more of again a beneficial to the middle class, working class individuals in the US. The next one is the overtime compensation. So there was no technically overtime. So overtime basically used to be treated as a regular taxable income only, and you have to pay the taxes just like any other income. But now they have started allowing the deduction for that overtime which you might be doing it. So whoever is kind of being paid overtime from their work, they'll be eligible for the deduction of up to $25,000 for the joint filers and $1,200 for single filers. So again, the same rule will apply for the phase out for that for every $1,000 additional $1,000 over and above the limit which has been mentioned. It will be reduced by $100. Having said that, this again is the target audience is the middle class worker who are kind of doing the overtimes, earning it very hard, and they want to give the benefit to them. So this both will be applicable from 1st January 2025, which is the current year now. So if any of the viewers has the similar business or who kind of pays that, they may take a note of it. With this, I hand it over back to Akhil. Thank you.
Thanks, Shanik. I think wonderful. You very seamlessly in a layman language, you You talked about how this the top marginal rate will impact and what are the pros and cons. I can see a lot of pros for the people. You talked about salt deduction tips and other things. Now I'll pull in another speaker, Shashank, to take us to how people can claim interest on their car loan in India or increase QSBS gain exclusions. I think he's the expert. He will talk more in detail. Over to you, Shashank. Thank you.
Sure. Thanks, Akhil.
Thanks, Akhil. Thanks, Dr. Atul. Warm welcome to all of you. So QSBS, Qualified Small Business Stock Exclusion. This was there since 2010 originally, but this is a very good move under the Act because a lot of strategic investors, founders, startups, they are getting the benefit of this new exclusion which has been given. The key difference right now, which they have given, is that the limit of earlier $10 million exclusion has increased to $15 million. And also, additionally, the benefit is now given in a phased out manner, which means that earlier the holding period of holding a qualified small business stock was 5 years as a compulsion. It is a zero exclusion versus entire exclusion with a percentage given, but the minimum holding period requirement was there for 5 years. But under the new act, they have increased, they have given the flexibility to disinvest at a period of 3 years, 4 years, and 5 years. With the 3 years of 50% deductions and 4 years, you get a 75% deduction and a 100% deduction if you are holding it for 5 years. So a very good move from Act perspective because the new strategic investors who has a lesser flexibility of exiting any investments, especially the startups which are turning into unicorn, and there are huge exits and cost which is there with a lesser flexibility. But now the flexibility has been increased where you can get a 50% deduction from your overall gain, but yet you are having some deductions available as well at the same time, which was not there earlier. Of course, they have increased the gross assets limits, which stock of the corporation is eligible for qualified small business stock. The company needs to have earlier a limit of $50 million as a gross assets. They have now increased it from $50 million to $75 million. And this increase is on various occasions is benefiting the large investors, and people are right now who are having a different kind of a structure, let's say a partnership structure or an LLC structure. They are right now trying to restructure and see that whether we can convert and get some cost at the today cost and maybe get a QSBS benefit, because then I will be getting this deduction only for the corporation. This benefit is only given to US corporations, and it has to be a corporation, meaning that even though it is set up as a LLC legally in any state, however, the tax election under the federal law should be of a corporation. Otherwise, you won't get benefit of the qualified small business stock. So I think that is a very key change they have brought in. The important another factor is that you are getting that 100% deductions, yet also you would be able to save any net investment income tax, which is generally chargeable to you on your overall taxable income of $200,000 to $250,000, depending on your filing status, which you will save that 3.8% if your gain will be completely excluded. So I think there are a lot of flexibility given in the current act, which was not there earlier. So I think it's a very good move for the investors who are looking for a flexibility in the exit, as well as it is also important for the fundraiser to bring in more investors to on the table, so that due to the QSBS benefit given by the OBBBA. Another one, which we are talking about is the qualified resident interest. It was also there in the prior act, but it was set to expire like earlier, the other provisions which we have on December 31st, 2025. Along with that, there was a mortgage insurance premium, which was not allowed earlier. But now under the OBBBA, they are treating the mortgage insurance as equivalent to the interest, and they are getting the benefit of given to the taxpayer with effect from 4th of July. However, the tax year which are going to file for 26 and onwards, they will be able to get this benefit. Additionally, the deduction which is available is only available for your principal residence. That's why they have mentioned about the word qualified residents. They will get the benefit of the interest with, of course, a limit of $1 million loan only. You can't get a loan where it is more than $1 million. So if you're having this loan for your primary residence, or you are having it for your secondary residence with some restrictions are there on that, you can get now the deduction of the qualified resident interest, which was earlier considered to be, part of your personal interest. Next slide. So the last one, I think there was no saving account as such benefit which was there under the prior act. It was there, but there was no federal saving account program specially designed for education, entrepreneurship, or home ownership was existed. Under the current law, they have given the benefit for the person, US citizen, who has been born between 1st of January 25 to December of 31st, 2028. There will be this account which will be automatically open at the time of birth unless specific parents opt out of that. Government will contribute certain amount as a fixed amount of $1,000 at the birth, which will be further invested like our fund which we have in India as a security, which will be further invested in a growth fund. And then at later stage, it could be further withdrawn by the age of 18 or a majority, when the children gets the turn of the majority, they will get the 50% withdrawal possibility only for the purpose of educations or entrepreneurship. And the entire fund which is being contributed to that, would be allowable for the withdrawal at age 30 completely. Additionally, there's a flexibility given to those relatives or employers or relatives. You can also contribute to that particular account for 5,000 annually. So, which is a very good flexibility being given that if the parents are not in a capacity to, save the amount or set aside certain amount for their children, but they have given the flexibility that the employers, families, relatives can also contribute to this annually, about $5,000. Thank you.
Thanks, Shashank. I think really great insights. But before we move to the next speaker, Nikita, to pull in to talk about, other things, we want to have a few clarification, if you can throw light on that. Whether US person can claim interest on car loan in India, is that possible?
So earlier, the home loan, which we just talked about, the home loan, the car loan was also there. They got introduced, but they are restricted to only US manufactured vehicle, which means that if a person sitting in India, living in India, they can't take the benefit of the car loan. The vehicle has to be manufactured in US facilities. Then the deduction is available. Of course, there are restrictions about $100,000, which is there. And basis that, you get the $100,000 is the limit on overall basis, which you can take as a deduction. Earlier, the car loan interest was considered as a personal loan, and any personal loan you are not able to get the deduction for. But now they have excluded the car loan from the personal loan category, and they have taken as a deduction which is available to taxpayer from the next year, 2026.
Okay. And my next question is on QSBS, which you just talked about. How will the increased QSBS gain exclusion and graduated holding period benefits impact tax planning for investors in early stage companies?
So I think as I just explained, I think the new founders, it is a landmark provision which has been provided where the new strategic investors can come in, and the founders of any companies or startups have a higher flexibility because they will become on board basis the fact that they will be able to exit in a 3 years, 4 years, or a 5 years time frame, vis-a-vis the earlier provisions where the restrictions was there to a compulsory holding period of 5 years with a no exclusion versus 100% exclusion. That flexibility has increased across US, and I think increased amount of $10 million or $15 million you get for a particular stock, which means that, let's say, if you are not completely disposing of your stock, let's say 100 shares were invested and you want to split only the 50 shares of the stock, then the investor can get the exclusion for that 50% stock at 50%, let's say if he or she is holding for 3 years period, and basically have a better liquidity, if that is the possibility, if somebody is looking at the liquidity. So I think the higher liquidity has been given, flexibility has been given, and there's a liquidity which could be there at an early stage rather than a very rigid one with a 5 years time frame, and flexibility around that you can dispose of the same stock over the period of 5 years, so that you can get a complete exclusion. Effectively, if you say so that if your holding period was 3 years, your current tax rate, which is approximately 20% of capital gain, long-term capital gain, and a 3.8% of net investment income tax, which is there. Effectively, tax rate comes to 24%. With this exclusion at 3 years, you get a benefit of effective tax rate of around 14%. With a 4 years time frame, you get a benefit of around 7%. And with a 5 years time frame, you have a effective tax rate of 0%. So I think, the flexibility which is being now given, and a good amount of $15 million is a very good amount for strategic investors to, kind of invest in a startup or any company who qualifies for a QSBS exclusion.
Understood. Thanks for such a detail. Now I'll come to Nikita, to take us through lot of clarity on estate and gift tax exemptions, child tax credit, the opportunities and miscellaneous, some miscellaneous in deductions which are available under different laws, and how the things have changed after this OBBBA has come into the picture. Over to you, Nikita.
Thanks, Akhil. Over the next couple of slides, I would like to divide my section in, for my viewers, into 3 parts. One is the deductions, what we can claim on the tax return. What are the additional and previous held credits which can be claimed by the taxpayers? And a very important topic to address is the estate and gift tax exemption. So to begin with, the miscellaneous itemized deduction. Under the Tax Cuts and Jobs Act, most miscellaneous itemized deductions such as unreimbursed employee expenses, your investment fees, and tax preparation cost were suspended for tax year 2018 through 2025. Now, these deductions had previously been allowed to the extent that exceeded 2% of a taxpayer's adjusted gross income, but the One Big Beautiful Bill Act made this suspension permanent. So we can no more claim these deductions anywhere on our tax return, meaning these deductions will no longer be returning to our 2026 as originally scheduled. Now, the important and a notable exception is in this scenario is the educator expense deduction, which remains in place. And having said that, there is clarity much needed whether that will be part of the itemized deduction or above the line with deduction, which it currently is being claimed as. So these changes simplify the tax code, but also reduce flexibility for taxpayers who previously relied on these deductions to offset work-related expenses specifically and the investment cost. A very important point to note here is that expanded definition for the educator expense. Now, this covers the coaches and certain physical education related costs as well, which was not the case earlier. So this is one important change brought in while computing your tax liability. Moving on to a very important topic, estate and gift tax exemption. Very much relevant and much awaited by a lot of taxpayers. Under the TCJA, the estate and gift tax exemption was temporarily doubled from approximately $5 million to 11 million per individual. And it provided significant relief for high net worth families. However, this increase was set to expire at the end of 2025, reverting to pre-TCJA levels, which means going back to $5 million, as stated earlier, pre-TCJA era. However, this bill OBBBA not only permanently extends this higher exemption, but also raises it further to $15 million per taxpayer or $30 million for married couples starting in 2026. And additional point is that it will be adjusted with annual inflation adjustments. So it means that post 15 million increase, it will again be further increased year on year, landing up to another material amount. This move offers long-term certainty and, of course, powerful planning opportunities for taxpayers, allowing families to transfer more wealth, of course, across generations without triggering federal estate or gift taxes. For business owners, it also means greater flexibility in succession planning, which is very, very important for larger corporations as well, and asset protection. In short, OBBA transforms what was once a temporary window into a lasting shield for preserving the family wealth. Next slide, please. Next is what we're going to cover about the certain credits which has been changed and updated as per the new bill. First one to talk about is the child tax credit. Under the TCGA, the child tax credit was doubled from $1,000 to $2,000 per qualifying child, with up to $1,400 as a refundable through the additional child tax credit. It also raised income threshold phase outs to $2 lakh for single filers and $400K for joint filers. These AGIs are very important to claim these credits, allowing more families to, of course, qualify. However, these enhancements were set to expire again in 2025. The OBBA not only make these expansion permanent, but also increases the credit to $2,200 per qualifying child, with both the credit and refundable portion indexed inflation-wise annually. For taxpayers, this means greater financial support, predictable planning, and of course, long-term relief amid rising cost of raising children. Families across income levels benefit from a more generous and stable credit, helping offset expenses and reduce overall tax liability. So a very good move from a tax perspective while claiming the child tax credit. Next in line, we have a very well-known and adapted tax credit known as American Opportunity Tax Credit. Under the TCJ, again, both the American Opportunity Tax Credit and the Lifetime Learning Credit remained largely unchanged. There was no change that time, 5 years back. It offered valuable support for education expenses. The AOTC, which is the American Opportunity Tax Credit, provided up to $2,500 per eligible student for the first 4 years of post-secondary education, with $1,000 being refundable, while the lifetime learning credit offered up to around $2,000 annually for a broader range of educational pursuits, including part-time, graduate studies. Everything was part of that package. However, again, the OBBA builds on this by permanently extending both credits and raising the income phase-out thresholds, allowing more middle-income families to qualify. Additionally, OBBA introduces inflation indexing for both credits, ensuring their value keeps pace with the rising tuition cost, what we have now. For taxpayers, this means greater access to higher education, reduced out-of-pocket expenses, and long-term planning certainty, especially for families with multiple students or those pursuing lifelong learning. Next slide, please. Next, we have a very important account being introduced for the first time, and this is mainly around a rollover from qualified tuition programs to ABLE accounts. Now, the Tax Cut and Jobs Act again introduced a powerful provision which allowed the rollovers from 529 college saving plans. So these are the plans available for college students, and this is to ABLE accounts. So we can move the money from 529 college saving account to an ABLE account, which is a game changer for families supporting individuals with disabilities. So that is the main purpose, or a set of people to help and support. This rollover option enabled transfer without any tax consequences, provided the ABLE account beneficiary is the same as the 529 plan, be it the beneficiary or a qualifying family member. The bill The current bill made this provision permanent. There is going to be no change after this. Of course, there could be a potential change in the amount being allowed in terms of no tax consequences. However, removing its original sunset clause for 2025. So for taxpayers, this means greater flexibility again in managing education savings, especially when a child's educational path shifts due to a disability. It also ensures that unused 529 funds can still support the beneficiaries' long-term needs like housing, healthcare, or assistive technology without triggering any penalties. Ultimately, the rollover provision empowers families to maximize tax advantage savings while adapting to life's unexpected turns. Last but not the least, there are a couple of credits around the clean energy. One is your clean vehicle credits and qualified commercial clean vehicle. The next followed by that is the energy efficient home improvement credit. And last but not least, residential clean energy credit. Under the TCGA and pre this era, clean energy incentives gained momentum, while credits like clean vehicle credit offering up to 7,500 for new electric and fuel cell vehicles, and the qualified commercial clean vehicle credit providing up to $40,000 for businesses investing in heavy duty clean vehicles. The energy efficient home improvement credit allowed homeowners to claim somewhat around 30% of qualified expenses, which included the insulation windows and heat pumps with annual limits of up to $3,200. Similarly, the residential clean energy credit supported solar panels, wind turbines, and geothermal systems as well, with a generous 30% credit. However, OBBBA made a very major shift in that. It completely eliminated many of these credits prematurely, most notably the clean vehicle credits and residential energy incentives, which were originally set to last through 2032, but now expires on end of September 30th, 2025. A very short time period for taxpayers to plan around these credits being expired. So for taxpayers, this means a shrinking window of opportunity, is how I would like to put it, to capitalize on these substantial savings. Those who act quickly, of course, can still benefit from lower upfront cost, reduced energy bills, and long-term sustainability gains. However, whether you're a homeowner upgrading your insulation or business investing electric fleets, these credit can significantly offset cost, but timing is everything now to deal with. Over to you, Akhil.
Thanks.
Most of the individual section where impacting the individual taxpayers under the OBBBA. So over to you now.
Yeah, thank you. I think all of you have done a wonderful job explaining in such a easy way how the things are changing, how the things are impacting. And before we go, we move to the corporate side of it, how the changes will impact the business. I have two questions which need your attention, Nikita. As you know, first one is, as an Indian NRI with US assets, how does the increase in the estate tax exclusion to USD 15 billion affect cross-border estate planning? If you can throw some light on that.
Sure. Thank you, Akhil, for the question. In fact, a very important question from individual taxpayer perspective. A very important point to understand here is that as a non-US citizen and non-resident, you're typically subject to US estate tax only on the US CITES assets, which means if you're holding a US real estate or a tangible property there, and to some extent certain stocks in US corporation, then only you are taxed on the estate tax. So having said that, if you with the higher exemptions, you have now more room to hold assets in the US and transfer those assets for your estate tax purposes. So a threshold of $5 million to going upward of 15 million, you have expanded your limit to hold wealth or create wealth in the US. And going forward, this will again, as per the inflation adjustment, this number will keep on growing further. And important point to notice, this number is anytime not going backward to 5 million or lesser, because these have been made as a permanent extensions in the law.
Thanks, Nikita. And my next question is, on the American Opportunity Credit and Lifetime Learning Credit under OBBBA, how the mandate of providing the SSN and AN of the institutions reporting rules for education affect tax preparers and families claiming this credit?
Very nice question, Akhil. So under the OBBBA, the IRS has actually tightened the compliances rules for claiming such, credits, especially the education credits, by mandating the taxpayers provide both the student's social security number and the education institution's EIN, which is the employer identification number, on a specific form commonly known as 8863. Now, this move aims to reduce fraud and improper claims, especially for the refundable portion of the AOTC, which brings in around $1,400 per student. It has historically been vulnerable to abuse because the SSN and the EINs were not required, and the forms can be filed without that to claim it. Now, for tax preparers, this means greater due diligence, verifying that clients have received a valid Form 1098T, which is to claim that this much tuition fees have been paid by them from an eligible institution, and ensuring that EIN is correctly reported. Now, for families, of course, it adds a layer of paperwork, but also protects legitimate claims, ensuring that credits go to those truly eligible for. The upside to it is faster processing, fewer audits, and more confidence to the IRS that your education-related tax benefits won't be denied due to missing or mismatched data. It's a small administrative hurdle, but I believe it has a bigger and better payoff in accuracy and integrity.
Thanks. I think for such a detailed and in a layman terms, because as you must be seeing that I'm making the notes. So I request everyone, because we don't see any questions coming from the audience at large. So I request everyone, please post your question in Q&A section. We may try to respond to all the questions if the time permits, or we will respond to you over the mail as the time permit. Now moving to the next section, which is changing how the changes are impacting the businesses. I will ask Shrenik to come in and take us through R&D expenses, bonus depreciation, limitation of business interests, some topics on that front.
Sure. Thanks, Akhil. So moving to the business part now. So there has been some interesting changes, I would say, which is now going to impact, or it is going to benefit in some matter, which we are going to cover now. So first is the bonus depreciation. This is a very popular depreciation allowance which is there in the US. So technically, you can claim the qualified assets, which means that 100% you can claim it in the year you purchase. So this means that there is no capping as well. So like whatever, if you are purchased in the millions, say 10 million, 15 million, 20 million, and X number of amount you have purchased, you can claim 100%, but it has to be a qualified assets. So we have seen in our clients that some of the asset-heavy companies who are there in the US, or they plan to start the business in the US, especially the tangible product companies, manufacturing, or the trading business which they're planning to start. So the asset-heavy companies, especially, we have seen that they are taking this benefit. So this bonus depreciation was always there in the law. So, but it was there, say 50% previously before Tax Cuts and Jobs Act. Then it was kind of increased to 100% in 2017. However, there were kind of gradual reduction, which was kind of expected, which you can see phased down in 80% in 2023, 60% in 2024, 40% in 2025. So that's how the phase out was kind of going to be. But OBBBA has made the 100% reduction, they have reinstated it, and basically it will be eligible, or this will be applicable from 19 January till 2028. So that's what their plan is, and they would want to. And as you can see, the narrative which even Mr. Trump is creating to do the production, to do the manufacturing, everything in the US. So this kind of reinstatement aligns with his vision, and it is his policy which he intends for the US. So this bonus depreciation is only eligible for, of course, the tangible products, not for the intangible ones. Again, this is another important consideration when there is a deal transaction, which is going to say, if you are acquiring a company in the US, this bonus depreciation kind of gives you the immediate tax benefit for the assets which you are acquiring. So the deal value or the deal considerations will also kind of will change because of reinstatement of this 100% depreciation. So the assets which are kind of going to be eligible, so the taxpayer can now plan their expansions in the US in the next 2 to 3 years and accordingly take the benefit of this. Then the next one is RN research and development expenses. So this is a very interesting impacting, I would say, to the businesses, especially to the SaaS businesses, technology businesses, which we have seen. So earlier, before TCJA, all the R&D expenses was kind of being eligible for the reduction in one or the other way through different sections of the elections. But from 2022, this section was expected. I mean, this section kind of provides that you have to capitalize all the domestic research or the foreign research. Basically, there are many companies which I have dealt with. They will have the marketing office or the small office in the US, and all the major chunk is done from the India. So those kind of companies will kind of consider as a foreign research. So when we say research, it does not mean purely which become as a layman term, purely doing the research, whereas there is scientific elements or something is there. So this is, or even the software development or the technology enhancements which you are doing it, or you are doing or preparing the softwares or the platforms for your customers on a contract basis are also covered. So it's a very wide definition, and it does not mean only in a layman terms what we have it is as the research that is kind of being covered here. So it's like a broad area. So whatever expenses which are there for the domestic expenses, you have to amortize over a period of 5 years. And whatever the foreign research expense are there, you have to amortize over a period of 15 years. And now you can imagine that if you are a SaaS company, you are considering 100% of revenue in the first year, but the expenses which you might have created, which can be a major one, is going to be amortized over a period of 5 and 15 years. So this starting in 2022, this was kind of expected that. But and if you recollect the events of the election, so in that 2021-22 only Mr. Trump lost. So everyone was technically expecting that Trump will be re-elected and this 2022 extension will kind of come in. So, but that didn't come in, and there were many pushbacks from the technology industry, and many representations have been made. But until this OBBBA Act, there was no I would say update or any changes which was brought to this law. Now under the OBBBA, now it's a settled position, I would say, and it is kind of again aligning to the Mr. Trump's agenda of pushing the US economy first. So they have kind of allowed now 100% kind of fully deductible domestic expenses or the research expenses which you are doing it, and you don't need to amortize it over a period of 5 years. However, they have still kept it the 15 years for the foreign research, and this will now start impacting especially the SaaS industry or the technology industry with the outsourcing of the work which is being done, and accordingly amortize it over a period of 15 years. So if you belong to one of this industry, and if you are having kind of this model, I would highly recommend it. I would highly recommend it that you have a conversation with your CPAs regarding this. There has been a transitional relief also which has been given, which is there from if you are, I mean, when I say for the small taxpayers, so that which means that if your gross receipts is less than 31 million, then whatever the domestic research expenses which you might have claimed from 2022 to 2024, you can amend those return and claim those expenses and do not need to capitalize for the domestic one. Foreign is still going to be capitalized. Next slide, please. So business interest. So this was again 10 Tax Cuts and Jobs Act. This business interest expense limitation was kind of introduced at 30% of earlier it was EBITDA, then it was changed to EBIT, which means that if you are a heavy depreciation claiming entity, you will have a negative impact on the interest expense which you are claiming. So under the Tax Cuts and Jobs Act right now, until 2024 tax year, this limit was from the EBIT perspective and not EBITDA. but that has been again reinstated to the EBITDA, and the higher limit or the highest interest expense will be now allowed under this OBBBA Act. This will be applicable from this January 2025. So from the tax year 2025, the taxpayers will be able to take the benefit of it. Lastly, from my side, it will be the Form 1099 NEC. So now 1099 NEC is something similar to, in India, we have Form 16A. So if you are, technically required to report all the payments which you might have made to the individual contractors or the certain contractors to whom the amount is more than $600. So that this form you are required to issue it annually in the month of January. Now this limit, this $600 limit has been increased to $2,000 because to reduce the compliance burden, to reduce the filings and everything from that perspective. So this limit has been increased to $2,000, and this will be kind of adjusted to the inflation from 2027. So this limit is kind of expected to go is kind of expected to increase it every year from 2017. So the compliance burden, the IRS is looking to reduce it, and accordingly, it will benefit the taxpayers. So yeah, that's all from my side. I'll hand it over back to Akhil. Thank you. Akhil, you're on mute.
Sorry, I'm on mute. Very insightful, and on bonus depreciation, that's being reinstated. I just want to understand how will this impact deferred tax calculation in financial reporting side of it. Though you talked about, please have a discussion with your CPAs and all, but I just want to understand how this, impact in financial reporting.
Thanks. So yeah, Akhil, so deferred tax calculation is kind of going to be impacted definitely because of this. So since you are kind of going to claim the 100% depreciation in the first year itself, which means your tax WDV will be technically zero, and the book WDV will be something say 20%. So it will be something will be there. So you will ultimately create a deferred tax liability for the books purpose, which you will be kind of carrying it over a period of time, because the book depreciation will be there for 3 years, 5 years, depending on the method which you are following. So there will be definitely a higher deferred tax liability in the financials because of the bonus depreciation, which you will be claiming it. So if it is going to impact in one or the other way the financials, then the company should look at it whether it will matter or not.
Perfect. Thank you. Let me go to Shashank now.
Sure.
To take us through few important concepts like FTC, which is foreign tax credit with respect to the tested income, base erosion minimum tax amount, concept on global intangible low tax income. Over to you, Shashank.
Thanks, Akhil. So I think in line with R&D credit and the bonus depreciation, the another interesting thing is on the GILTI side, which is global intangible low tax income. Earlier enacted under the TCJA Act by the Trump administration in this earlier chance, the global intangible low tax income is originally introduced for the companies who are keeping their profits through their subsidiaries outside US. They want to bring it back. And that's why they introduced a transition tax, which was enacted for 2017. And company having the profits outside United States has paid those one-time tax to the government at that point in time. And post that benefit, the taxes which has been passed on to the government, they introduced the GILTI that every year from 2018 and onwards, whatever you are going to earn, you pay a certain amount of tax to us if you are not paying enough tax in the foreign jurisdiction, to minimize the base shifting which is being done by the global US parented corporations and keeping the profits in the countries like Ireland, where the tax rates are not that high. So with that, GILTI was introduced, and the changes which they have done in the OBBBA, that earlier the deduction was given in the original act of 50%, which means that if your $100 is getting taxed, only the GILTI of 50%, which is $50, is going to be taxed. That deduction was going to be phased out to 37.5%, which means that 67.5% GILTI would be taxed. Under this new law, they have made the deduction to 40%, which brings down to the percentage of 60% taxability of GILTI. which makes it an increase in the little burden on the taxpayer. But at the same time, in the earlier provisions, there was a restriction on calculating the foreign tax credit under IRC 960, where the deemed foreign tax credit would be calculated, and the restriction was about 80% utilization only. Now, what they have done is that they have changed that and increased it to 90%, which means that at one side, the deduction percentage has gone up permanently, but at the same time, they have increased the foreign tax credit, overall limit, so that the limitation is not there that much. Effectively, the earlier tax percentage, which was earlier calculated as follows, where the US has brought 21% corporate tax rate, and anybody who is at least having a 18.9%, which is 90% of 21%, the taxpayer were eligible to take high tax exception completely, which means that the guilty was not offered to the tax, and you get the deduction of the entire guilty, not just 50%. However, it used to impact the state taxpayers, because some states have not bring back the conformity with the federal law. And that's why the calculation would be a little different from a state perspective, even if you would have got the deductions of 50%. But having a high tax exception, the completely at the gross level, the income is not includable. And maybe you are able to have a same impact on state as well. Secondly, it could also impact those taxpayers having in losses, especially the companies who are having a transaction in a particular year, or in an early stage startup, or during COVID times, we have seen that there were many corporations having huge losses, and they were not able to make it up. So the guilty inclusions were subject to the utilization of those losses, which means that you are not able to get that 50% deductions as well. So now the effective tax rate on guilty is being 14%, which is you calculate the restrictions of 40% deduction, you get a taxability of 60%, which takes to your tax percentage of 21% into 60%, which gets to 12.6%. And since now you have an enhanced foreign tax credit limit of 90%, if you reverse calculate that, your tax rate effectively comes to 14%, which means that if your foreign subsidiaries is paying at least 14% tax in a foreign geography, there is no guilty tax impact as such, even under the new tax regime. Thank you. Next slide, please. So BEAT, another provisions which is being affected, a lot of Indian multinational companies, especially IT companies, GCC models, who are working in a model where there are a lot of outsourcing being done to India. The BEAT has been like a killing percentage from a tax perspective. There was originally the provision was introduced because, again, on the similar lines of guilty, where the base has been shifted of the company from a certain US geography to a foreign geography. And so this was introduced as on a taxability of at least 10% of the overall your modified taxable income. It used to be adding back all your foreign related party payments. And if it is not covered by any exceptions, you add back to your taxable income and recalculate, like we have a MAT provision in India, and you calculate that percentage of tax on the modified taxable income, which was leading to a very high taxable number, or effectively your effective tax rate. Now, when the bill was proposed, there was an exceptions added under those list of foreign related party payments, where any payments which you are making to a foreign geography, and that foreign geography is taxing that amount at least at 18.9%, then those payments will not be considered as base erosion payments. And there was a relief at least was expected. However, when the law was passed on 4th July, this was withdrawn. And in the final law, there was nothing about the high tax exception, which means that your current 10% has now, of course, was getting replaced by 12.5%, but they have made that permanent to 10.5%. So a 0.5 increase without any changes much to the existing, your overall BEAT law. It remains the same. It has affected a lot of multinational companies. And of course, it will be effective for the tax year starting after 1st Jan 2026. And parallelly, we have FDI, which is now being considered as foreign derived deduction eligible income. So the concept has been modified. Instead of FDI is now FDI, and the benefit deduction, which was earlier given as 37.5%, has now further reduced to 33.34%. It is in line with what the GILTI tax rate would look like, but it is from a flip side of it that the person who is exporting from US, how their overall ETR, which was effectively getting reduced by getting the FDI deductions, now they have a slightly increase in their effective tax rate because they will be now able to claim a reduced tax deduction, or rather deduction of those income, and therefore their slightly increased tax will happen again. But there's no as such a date, but since unlike other law of GILTI, it will also apply for the tax year starting after 1st Jan 2026. So I think with all these provisions, are there, but as such, the relief overall, which was expected, and as a taxpayer, if you look at it, not much, changes from a business side of, at least on this front, were given. Of course, they have given for the R&D and 163J and the bonus depreciation. But on the international side of it, if we have to talk about it particularly, there is no much relief given on the GILTI or BEAT side of it. Rather, it remains more or less the same. Okay, thank you. That's it.
Shashank, thank you. Before I move to the last section of our discussion today, I just want to ask from a US exporter perspective, how this reduced FDDI deduction rate impact the effective tax rate and planning for US exporters.
So I think effectively, as I just spoke, there will be a less than 1% effective tax rate change, approximately 0.87% increase in the overall effective tax rate would impact to the exporters. Additionally, if at all, somebody wants to plan better, but, as such, there's only a 0.87 element. However, if somebody is exporting largely from US rather than importing it, then definitely they need to model it up with their global transfer pricing policies and other strategy so that their effective tax rate gets optimized.
Understood. Thanks, Shashank. Last section of our webinar today. I'll ask Nikita to conclude this, excise tax on remittance transfers, and throw some light on enforcement of remedies against unfair foreign taxes and all. Before we open this webinar for any Q&A we might have. Thank you.
Sure. Thank you so much, Akhil, again. And this section is all about a newly introduced law under OBBBA. The first one is around the excise tax on certain remittance transfers. So the One Big Beautiful Bill Act introduced a new 1% excise tax. In fact, in the provisional bill, that was expected to be 5%, but thankfully in the final act, it came down to 1% on certain remittance transfers under section 4475, effective for transfers made after December 31st, 2025. So this date is very crucial in this case. This tax applies to electronic fund transfers initiated by individuals in the US to recipients abroad, including those made via cash, money orders, cashier's checks, or similar instruments. While originally framed as targeting undocumented immigrants, the final version applies broadly to all senders, including US citizens and residents. So this tax is collected by the remittance transfer provider at the time of the transaction. And if not paid, the provider becomes secondarily liable, not as a primary liability lies to them. For taxpayers, this means higher cost, of course, for cross-border support, especially for families sending money to relatives overseas. However, some exemptions. The good part is there is certain exemptions which exist, and these are such as transfers handled or funded by US debit or credit cards, or sent from certain financial institutions. So the provision is expected to generate roughly around $10 billion in revenue if such channels are being used, such as cash or money orders to transfer money abroad over the expected 10 years timeline. But it also raises concern about its impacts on low-income households and immigrant communities. Next slide, please. Thank you. The next one is all about the enforcement of remedies against unfair foreign taxes, which covers under the IRC 899. The proposed section 899 of the Internal Revenue Code, introduced in the One Big Beautiful Act, again represents a bold shift in the US multinational or international tax policy. It targets foreign jurisdictions, of course, that improve discriminatory or extraterritorial taxes, such as digital service taxes and the undertaxed profits rule. Under the OECD's Pillar 2 framework on US persons and businesses both. Under this provision, foreign individuals and entities from such jurisdictions could be facing escalated US tax rates on income sourced from the US, along with enhanced withholding taxes on payments. For American taxpayers, of course, especially multinational companies, this retaliatory, I would say, measure aims to level the playing field, discouraging foreign governments from targeting US economic interest unfairly, while the TCJA laid the groundwork for global tax competitiveness. Section 899 goes further by defending US taxpayers against foreign tax aggression, potentially reducing the burden of double taxation and protecting American investments abroad. However, it also introduces geopolitical complexity, and there will be, implementation could affect certain.
I think we've lost her. Shainik or Shashank, you want to complete?
Sure. So I think it is more linked to the OECD Pillar 2 norms and the BEAT and the tax rate which is there. Originally, since OECD Pillar 2 which came in, Trump withdrawn it when he came into the picture in January of 2025. At the same time, the practice was introduced, as with this section of 899, so that any unfair foreign taxes which has been there, but as of today, this tax has been completely been withdrawn, and it's not yet advancing because though at the same time where the America is not accepting OECD Pillar 2 because they have these BEAT, GILTI, and we just spoke about, at the same time, they want to go about this provisions to increase the taxes. But now since OECD and the G7 nations have OECD Pillar 2 norms, and US are trying to bring Section 899, but it is unfortunately not now advancing. Good for overall foreign group, but it was of course not benefited to overall the overall US parental group which is there, and they're having subsidiaries based out of foreign countries, but it is not advancing at this stage. Yeah. And the rest of it, Nikita has covered, I think. Yes, thanks.
Yeah, Nikita is back. Thanks, to fill in. So Nikita, I think we lost you due to some technology issues, but now you're back. Before we conclude today's session and webinar, I have one question for you. As you said that in excise tax, 1% excise tax is there on the outbound remittance from the US. Will this apply to NRIs sending money to India? And if yes, how can they ensure exemption compliances? If you can throw some light on that.
Thank you for the question, Akhil. But before that, my apologies on the technical glitch that I dropped out a couple of minutes. And to answer your query, certainly the tax applies to non-US citizens, including NRIs on H-1B1 visa or L1 or student visa F1, who send money abroad using cash-based or non-bank remittance channels. So it's a transaction-based tax, not a withholding or income tax, and is collected by the remittance transfer provider at the time of transaction. And what are the ways to avoid such a tax is the Senate version of OBBBA did introduce certain exemptions that will benefit NRI, which means that please transfer money made via US bank accounts. Most importantly, do payments using any US issued debit or credit cards. And last but not the least, any ACH transfers and credit union transactions. So these are the methods which will not be subject to 1% excise tax, meaning most NRIs using regulated financial channels like online banking, mobile apps, or card-based platforms can continue sending money to India without any additional cost.
Thank you. Thank you. With this, we conclude today's session because I don't see any questions on the Q&A. And thanks to all of you for joining us today for this insightful session on one big beautiful bill. It was so easily explained. Thanks to all the panelists and the way I've understood, I've made a lot of notes. I hope the discussion helped clarify the key provisions for everyone of this new legislation and its implication on individual and business at large. As US tax policy continues to evolve, staying informed and proactive is essential for effective planning and compliances. I think I agree with most of the things which we've discussed. And still, if a few of the questions are not answered, we are happy to, please send us the mail. We're happy to address that. We extend our sincere thanks to all the panelists again for their valuable perspective, insights, and again explaining it so seamlessly in a layman language. And our thanks to Indian American Chamber of Commerce for their collaboration in making this webinar possible. So thanks everyone. Happy to conclude with this amazing note, and looking forward for more such kind of updates. I request our experts to keep on coming and enlighten our audience at large with whatever updates are coming, because these days there's a lot which is happening on the US market. Thank you.
Thank you.
Thank
Thanks.
you.
Bye.
Thank you.